Welcome to 3PL Value Creation Asia Summit 2020. We are going through a healthcare crisis of our generation, and we are going to discuss today developments in 3PL investment, mergers, and acquisitions. We have seen a lot of headwinds in the last 4 months, and the market will continue to be uncertain going into the next 12. M&A market has been as fluid and as uncertain as the general business environment is. So we are going to discuss today as to what is really transpiring in the market, and we are going to analyze based on our predictions where the market is heading and what the market has done in the last 4 months. We are going to start this discussion with an impact of COVID-19 on the markets and generally on M&A. Quarter 1 and 2 overall has seen a devastating impact generally on the businesses, especially small businesses worldwide. But based on ANA's estimation, it is a 10% iteration in gross revenues, uneven by different segments. The hard hit segments have been transportation brokerage, freight forwarders, and also industrial sector has been hard hit. B2C e-commerce fulfillment has shown the growth and the secular trend. This is the only segment, along with the value-added distribution and warehousing, has continued to show a lot of good activity in the last 4 months. And we believe that it's going to continue to show a very strong activity in the next 12 months. Domestic transportation management has been hard hit. Intermodal volumes are down. There has been a spot market contraction and strong trends of recessionary nature, where we have seen the GDP falling and the market estimates or the economic estimates for the next 12 months we are talking about a reverse or a negative GDP growth. Unprecedented. It's even worse than 2008. International transportation management volumes are off. The only bright spot is air freight. I was talking to a senior DHL senior executive last week, and he said the only bright spot is air freight, where North America is almost reaching a saturation point in more air cargo capacity. Value-added warehousing and distribution has seen reduced activity, major inventory drawdowns, pricing supported by contractual terms, and everybody is looking for a flex space instead of fixed cost. We are going to see some turnaround of activity. I think we have also seen in the month of June, USA actually added about 4.8 million jobs, which was a very, very good news. The stock markets have bounced back pretty well in the US and in the Canadian market. Q3 and Q4, we're going to see some demand waves. 4 to 8% increase in volumes and gross revenues. Domestic transportation management will continue to show much improvement as the capacity and the loads recover and economy opens up. Although there's a lot of uncertainty in the market because of the extent of volatility as the COVID-19 cases continue to surge in the US, in India, and in Brazil, that continues to create a lot of volatility. Headwinds are strong. We are definitely staring at a consumer-led recession. Consumers that create a lot of traction on consumer spending that drives almost 2/3 of the economy. The same consumer is now hunkered down, put inside the box. And we are going to see this recession is different than 2008. 2008 recession was more induced by the collapse of the financial markets. We are going to see a consumer that continues to rally the economy by the discretionary spending is going to be really backing off in terms of the consumer spending habits. One growing realization because of the COVID-19 has been the extent of digitization, and the companies that were digitally mature, technologically savvy, have seized the initiative in the last 4 months because of the current situation of remote, virtual, social distancing. that has helped those companies, and especially digital companies that have already got the economics in their favor. But traditional 3PLs have struggled. So one learning lesson out of this is everybody needs to get very fast, adapt to technological evolution if there is another wave of COVID-19. What is the impact of COVID-19 on M&A? The deals are getting in a pause mode. The buyers are challenged with valuations because of the next 12 months of uncertainty or the next 24 months of uncertainty. The sellers do not want to sell the companies at a COVID discount. The financial institutions and the bankers are pulling back sharply on the leverage debt because of the risk factors in the economy in the next 12 months. Valuations are influenced by the financing environment, and capital structure is influenced by the capital markets. We know that these are true even without the pandemic, and today this is becoming more important in the market. The valuations are being challenged. You can't take any valuations for granted, and the capital markets are extremely risk adverse. There is a lot of uncertainty in the next 6 to 12 months, given all global sectors and given all global geographies. That uncertainty creates volatility, and that creates a lot of challenges in businesses and in M&A. Small businesses world over are going to be continue to be challenged. The developed countries have continued to put money in the hands of businesses and individuals, and that has also created a lot of stimulus and boosted the demand. Strategic players with strong balance sheets and cash will continue to leverage opportunistic buy-side strategy. Although the deals are getting in a pause mode, the buyers are challenged and the sellers are challenged, there is still a tremendous amount of dry powder in the sidelines. We believe, in our estimation, almost $1 trillion of dry powder in the market waiting to be deployed into accretive deals. One advice to owners and companies, that we would like them to be proactive about their transactions. They plan ahead and they want to manage their process extremely carefully. There's a market fragmentation that creates opportunities for consolidation in the 3PL sector, and this is not just about pandemic. This is regardless of the pandemic. I think 3PL is a very opportunistic investment sector for 3PLs. For private capital with very strong IRR. The bankers are pulling back sharply with the debt financing is a major issue in this uncertain market. They don't want to underwrite the last 12 months. They want to underwrite the next 12 months of a realistic EBITDA at a reasonable leverage. Valuations are challenged. Deal structure and earnouts will play a major role. You need to de-risk your M&A strategy, and you don't take your valuations for granted. And at A&A, more than our M&A, the turnaround and restructuring practice is growing rapidly because there's a lot of pain in the market, declining profits, stagnating sales, strategic risk, liquidity risk, profit risk. This is creating a lot of opportunities for turnaround and restructuring. Consumer spending that drives GDP growth and the manufacturing output are challenged, and the economy continues to be volatile and uncertain. There are some permanent changes occurring to the buying and the social behaviors, at least in the next foreseeable future. Whether we'll go to a Raptors game, whether we'll go to a big concert or a big tennis tournament, or whether we'll do a discretionary spending is all question marks at this stage. Mid-market and lower mid-market intermediaries will likely face significant impact due to COVID-19. This is the sector in Canada, in US, and in Western Europe that is going to be severely challenged. And it will take months, if not more, to get those folks to recover. Financially distressed companies will likely become attractive buying strategy for some buyers. Even in the economic downturn, I think there are opportunities to create value in an economic downturn, and those are the winning strategies that we're going to talk about. 3PL sector has to embrace higher level of lights out business model. Technology and innovation is absolutely critical. Increasing digitization is important in case of eventuality uh, of another COVID-19 wave. Artificial intelligence and machine learning are critical for different parts of the business, career procurement or sales. One distinguishing factor between the traditional 3PLs and the digital 3PLs is the freight unit economics is creating a major differentiator. The cost of acquiring a customer versus the cost of assigning a load to a carrier are extremely important. 3PL is a labor play. 3PL is a HR and technology business that just happened to be a transportation. How much labor you burn to earn $1 of margin either makes you or breaks you, and that's the differentiator. We are going to talk about some deals between 2015 and 2016. UPS buying Coyote Logistics for 15 times because it was a very strategic asset. Genco was bought by FedEx, which is a reverse logistics leader, for 9.8 times in 2016. Transplace getting sold 3 times to private capital for a significant multiple. That tells you a strong and a secular growth trend in the asset-light 3PL industry. Global Trans, acquired by the Jordan company and within 9 months being flipped to Providence Equity for more than 2 turns, is an absolutely unprecedented transactions in the 3PL industry that again reinforces our thinking that it is a very, very attractive IRR. M&A activity has been very prolific in 2019 and 2020 until the pandemic hit the markets. 3PL acquisitions over 1999 and 2019 will tell you a trend of the multiples. And in 2008, you'll see the multiple. 2007, there was a bubble. 2008 was the economic meltdown. And in 2015, you'll see a big spike with the transactions like Coyote and Genco. 3 times Transplace was transferring to private capital from a CI capital to Greenbrier to TPG capital just tells you that how strong the growth trend has been in asset light market, this is an exceptional transaction. My philosophy about multiples are overemphasized in 3PL industry. You need to back into a financial model for next 5 to 7 years with a 12-month trailing EBITDA to get you that magic number of multiples. But over a period of time, we have realized this multiple has been way overemphasized. No doubt that the deal flow is challenged. If you're talking about 20, 30, $40 million assets, EBITDA assets, those are not many in the market. So demand and supply, somebody's going to pay you a very high price to buy those assets. This is a buyer's market, at least for the next 12 to 18 months. And the buyers should really try to leverage their cash to go and buy some opportunistic deals. What are the drivers for M&A? These are typical hot buttons that really create some traction for M&A. Size and scale of operations, business model, your brand strength, your aligned and an excellent management team, your solid financial track record and earnings, your strategic plan, your technological preparedness, and your extent of your TMS configuration and digitization, diversified customer base and a customer concentration, your vertical industry e-commerce expertise. A value-added business always get a multiple that is premium multiple as compared to a commoditized business. Asset-based versus non-asset, it's pretty clear as to asset-based will always fetch lower multiples as compared to light asset because of the capex. There's a $1.3 billion coming into this industry to digital freight matching over the last 5 years is a phenomenal development, very disruptive, because these digital freight companies are certainly in the process of grabbing the market share. And venture capital, private capital are pouring in money because of a significant market size and a significant IRR that continues to attract investors. There's one segment in this 3PL industry that continues to do extremely well, especially during the pandemic and going forward in the next 12 months. It's a strong and secular growth trends are driving internet e-commerce. Deeply fragmented market beyond Amazon, which controls 45 to 50% of the US market share. Amazon has got two distinguishing features. One is the customer-centric approach and the fastest way of getting you the product. Amazon controls about 40 to 45% of the US market now as compared to in the past. There are some strong competitive sets developing in the marketplace as well. Need for outsourcing and expertise of e-commerce providers to cater to large internet retailers and mid-market brands. Value-added e-commerce providers attract a lot of investors as compared to commoditized businesses. There is significant potential for a mid-market roll-up and consolidation strategy because of the market's defragmentation. Extremely good ROI potential for e-commerce investment and roll-up strategies. We see a growing trend of Chinese and other e-commerce providers entering the North American market. Technology and innovation are playing significant role in e-commerce. Cross-border and Canadian e-commerce providers are in great demand. Let's take a look at some of the deals that have occurred in the last 2 years or 3 years on e-commerce that tells you the trend. Examples include the privatization of online content from Thomson Reuters Finance and Walmart buying Indian e-commerce giant Flipkart. 2018 had 18 transactions for value in excess of 1 billion, topping activity in 2017. Silver Lake Partners acquired Zoopla for a whooping 26.4 times in 2018. E-commerce startup ecosystem is undergoing major transformation. Startups need to guarantee disruption in specific verticals via a serious data-driven platform. Existing e-commerce companies are increasingly attracting new funding, such as the Korean giant Coupang, $2 billion, and Indonesian e-commerce company Tokopedia with $1.1 billion. Due to secular growth trends, we expect valuations and ROI to be very strong in the e-commerce sector for the foreseeable future. There's a huge potential for a mid-market roll-up strategy. North America accounts for 43% of e-commerce spend, and the Asia Pacific is another significant growth area. Now we are going to talk about the impact of COVID-19 on the markets. First and foremost, corporations are focused on keeping their employees and businesses safe in these turbulent times. Amid increasing uncertainty, however, many corporate leaders are being asked to make strategic decisions. For example, should they call off a transaction that has been in the preparation stages for many months or push it through to completion? Has the plunge of more than 30% in equity markets created buy-side opportunities? Against this backdrop, we look at the current state of transaction market in transportation logistics vertical and offer advice on how deal makers should proceed. What do deal makers be thinking about? When deal makers are ready to focus again on their core pursuit, they will have plenty to think about. For companies that have built a healthy balance sheet during economic boom of the last 10 years, declining valuations create opportunities to pursue deals that create long-term value. Our experience demonstrates that deals done during weak economic times create value for deal makers and their shareholders. Lower valuations are not the only reason that weak economy deals outperform. In a public takeover, the discount when acquiring targets might be lower, than expected because the shareholders demand significant premiums. There is a fundamental reason why acquisitions in weak economies create value. A company can take advantage of the environment to execute its strategic acquisition agenda and to position the business to exceed industry average growth once the economy recovers and accelerates out of recession. Additionally, a company can focus on integrating the target during the downturn when competitors are busy trying to survive. What are the winning strategies? The first, look beyond your core business and synergistic deals. While acquiring targets in your core industry during a downturn creates value, you can benefit even more from non-core acquisitions. Be creative about your deal structure. Ideas like extended closing, creative, and thinking outside the box approach, such as innovative earn-out models, could be winning strategies. Learn from experienced deal makers. Acquirers that regularly engage in M&A earn returns from downturn deals that are 5 times higher than those earned by occasional deal makers. In the current situation, experienced deal makers can fully leverage their well-honed, structured approach. A&A's domain expertise can lead you to quality diligence, which assumes greater importance at this time. This means conducting a focused diligence process without being distracted by external crisis, deploying scenario planning in order to be prepared in a fast-changing environment, and rigorously integrating targets to jumpstart value creation. Don't take value creation for granted. When acquiring underperforming assets during weak economic times, even experienced deal makers create value in only half of their deals. Consider de-risking your M&A strategy. If your industry is being hard hit by current crisis, consider deploying tools rather than outright M&A. Form strategic alliances. With that, I think we are now going to close this discussion by saying there are strong headwinds in the market. The market is very dynamic, although the silver lining is we are beginning to see some green shoots. There is more enthusiastic buyers and sellers coming to the table. There are certain sectors of the 3PL segment continues to excite everybody. E-commerce, transportation brokerage, which is DTM, value-added warehousing and distribution, consolidation, defragment the market. There's a lot of private capital and there's tremendous amount of dry powder out in the market, and the private equities are very, very keen to invest in the asset-light sector. With that, I think one closing advice is we begin to see the economy opening up, the uncertainty about next COVID-19 wave, if at all it occurs. But stay safe and continue to keep your ears to the ground and eyes open. And we believe that the M&A market will continue to evolve. Thank you.